Hello participants, my name is Dr. Amit Sharma and today we are going to discuss the topic named cost volume profit or BEP analysis. This is very important topic for those who are preparing for NET examination or doing BCom, MCom and finance background. So it is really important and for your exam point of view. So let's start without any delay. The analytical technique used to study the behavior of profit in response to change in the volume, cost, and price is called the cost volume profit analysis. As you can see, as per the name, the cost volume profit. So it is interlinked. It is interlinked. There is a relation between the cost, volume, and profit. So, and in this topic we discuss. That the impact of these things on the profitability. So in this particular topic, there are few subtopic we need to discuss to understand the scenario of break-even point. So we need to discuss and we need to identify how we calculate profit volume ratio, break-even point, margin of safety, desired sales, and desired profit. So let's start with the break-even point profit volume ratio. And before study the profit volume ratio, we need to discuss some important points like SVCFP and what is that. And before starting this concept, we need to focus on these mnemonics. So S stands sales, V stands variable cost, C stands contribution, F stands fixed cost, and P stands profit. We all know that what is the sales and what is the profit. Definitely the profit is the amount which we recover on over the cost. And what is variable cost? What is variable cost and what is fixed cost? So we elaborated, and variable cost is the cost which is vary according to the production. So if the production is increased, the cost is also increased with the same pace. If the production is increased by 10%, then cost is also increased by 10%. If the production is decreased by 10%, so the cost is also reduced by the 10%. So it is vary according to the production level, and it is fluctuate with the same pace. When the production is increasing, the cost is increasing. If the production is decreasing, the cost is also decreasing. And what is fixed cost? Definitely we know that the fixed cost is something like, as per the name, the cost which is in the nature wise it is fixed, like rent. If there is no production and the production is twice or thrice or double or any level of production, the fixed cost, the standing cost is also stand, because there is no movement in the total volume of the cost. Somehow it will increase or decrease, but that will be in an exceptional case only, in the exceptional case only, and otherwise in due course of normal business, it is in constant in nature. So, and now we discuss that what is contribution. So contribution is something which we recover over the variable cost. The volume of sales, the amount of sales which is over the variable cost is known as contribution. So there is a income pro forma. You can see that there is a headline in pro forma income statement. So SVCFP is called Reddala Life Jingalala. So S minus V equals to contribution minus fixed cost equals to profit. Let's see this example. And here the sales, this is calculated on the basis of the per unit. So the sales amount is ₹10, variable cost is ₹6. So we need to easily calculate contribution, which is 4, and fixed cost is also ₹3 per unit, and the profit is ₹1. Here you can see that if the sale price is 6 and the variable cost is if the selling price is ₹10 and the variable cost is ₹6, so the contribution is 4. So the contribution is rupees 4, and you can see also that the profit plus fixed cost is also the same amount. That means the contribution is sales minus variable, but we can also calculate contribution if we add fixed cost in profit. So we have the formula like sales minus variable cost equals contribution, and contribution equals to fixed cost plus profit as well. And here, suppose number of unit is, overall number of unit is 100. So the impact of 100 unit or total income statement is like, see this. So the sales overall is 1000, the variable cost is rupees 600, and contribution is rupees 400, and fixed cost is rupees 300 in total, and the profit is rupees 100 in total, because we are getting 1 rupees on per unit. So on the 100 unit we can get earn 100 rupees as well. So here you see that the contribution is 40%. If the contribution is 40%, then 60% will be the variable cost. If the contribution is 70%, then variable cost will be 30%. If the contribution is 20%, the variable cost will be 80%. So this is important relation between the sales and variable cost, because the result of ultimate in the form of, we can get in the form of the contribution. Okay, suppose fixed cost is rupees 300, and we can see that the number of unit is 100, and this is the basic example, and I'll carry with the same this example for all subtopic. So you must keep in your mind that this is very important figure. So fixed cost is equal 300 rupees, and when the number of unit sale or produce, number of unit of production is 100, then cost per unit will be 3. Suppose if the number of unit is 150, then in that case the fixed cost will reduce to 2 rupees from 3. And if the production is twice from previous level, that is that was 100, so in that case the cost will be 1.5 rupees per unit. So you can see that the fixed cost per unit is variable and variable cost per unit is fixed. So there is a reverse kind of relationship between fixed cost and variable cost. The variable cost is fixed per unit on the basis of per unit, and the fixed cost is variable according to the level of production. So if the production is increasing continuously, then you can see, you can check the cost per unit is continuously decreasing. If the production is decreasing from left to right side, from right to left side, suppose there is 200 unit was the level and 1.5 is per unit cost, fixed cost, and suppose we reduce our production 200 from 100 unit. So you can see that if we reduce the production, then the cost of per unit will be increased from 1.5 to 3 rupees. So this is the interesting example. So the next topic, what is break-even point? So break-even point is a situation where the firm earns no profit or no loss. This is the situation where we are providing, you can say, social services. So we are not getting money. We are not earning sufficient money to make a profit. So this is the situation, and it is only happen when the total revenue is equals to total cost, and total cost is the combination of the variable cost and fixed cost. And here to discuss one of the important thing as well, that why the total cost is the combination of variable and fixed. So why? Because we can consider the all kind of the cost into only two forms. First one we categorize in variable cost and another one in fixed cost. So there is only two type of cost. It is not a method. First you just clear your mindset that this is not a method of costing, or this is not a method of any kind of accounting. This is only the technique to make a decision in proper way. Okay, so there are suppose you are following ABC costing method, processing method, and any of the method of cost accounting. But if you follow the marginal costing, or if you follow the break-even point, you can classify these costs into two categories. First one is fixed cost and another one is variable cost. So this is the very simple thing to keep in your mind. Are only two type of cost. First one is variable cost and another one is fixed cost. Why the BEP is important? So with this topic, we can easily decide our target revenue. We can make a better decision to save our time or money. We can set easily a target pricing. That means a smart kind of pricing. We can provide discount. Most probably we saw that if we visit the supermarket, then we saw that there is a 40% off, 30% off. Why it is happen? But we not find that in general stores, normal shops. Why there is no discount is available? Because they had some kind of the factor which the normal shop or normal shopkeeper doesn't have. So you must we understand, we explain in later, and it is important to make a proper business plan. And how? Let's see. The profit volume ratio. Suppose the sales is 100, the variable cost is 60, then the contribution will be 40%. And you can see if the variable cost is changed from 60 to 70, 70 to 75, 75 to 80, you can see that with the same pace, the contribution percentage is also reduced. When the variable cost is increasing, the contribution percentage is also decreasing with the same rate. Okay, so what is PV, profit volume ratio? Profit volume ratio is nothing. Profit volume ratio is the ratio between contribution or sales. So the percentage of contribution is known as a PV ratio, and the PV ratio in the amount known as a contribution. So we can say that the presentation of contribution in the form of percentage is known as a PV ratio, and the PV ratio, the presentation of PV ratio in the form of amount is known as a contribution. So this is like Gangadhar hi Shaktiman hai, Shaktiman hi Gangadhar hai. So next, break-even point, we already discussed that it's at a point where the firm earns no profit or no loss. It is a situation where the total cost equals to revenues. So this is break-even point, and this is the graphical presentation of break-even point. How break-even point we can calculate with the help of this formula, or do we need of this formula, or we can calculate with the concept of SVCFP, with the help of SVCFP. So let's see. Suppose we know that, we understand that at break-even point level, there is the profit will be nil. There is no profit. If there is no profit, and we already know that the fixed cost was 300 when we did a previous example, and the fixed cost was 300. If the fixed cost is 300, then contribution will be 300 also, because if the contribution is exceeding this limit, then the result will come in form of the profit. If the fixed contribution is less than the fixed cost, then the result will come out in the form of loss. So it is mandatory to, at break even point level, the contribution must be equal to the fixed cost. So that's why this formula is working, because if the fixed cost is 300 rupees, and we also know that the variable cost was 60%. So if the 40% is contribution equals to 300 rupees, then 100% will be 750. And now we can easily calculate variable cost. So I did this equation with the previous example. So you must keep in your mind that and this will continue for another topic as well. So if we are getting 4 rupees on per unit basis as a contribution, so for collecting of rupees 300, how many unit we must sold? 75 unit, definitely 75, and the selling price was 10 rupees per unit. So the sales amount will be 750. Next topic is margin of safety. Margin or safety. There are 2 points. Margin means profitability and safety means safety. Obviously, safety is how our business is secure. When will we continue our business operation? And we can continue in the only situation where we are getting something. If we are getting at break-even point, we are running at break-even point or below a break-even point, we never sustain for long term. So we need to, for business point of view, there is a necessity to getting to make money in the form of profit. So here is the formula. The statement is always there. So SVCFT, and total previous level sale was 1,600 as a variable cost, contribution was 400, and fixed cost was 300 as per the previous question. Here is the mistake, so I am correcting it, and the profit will be 100. The profit will be 100. This is wrong, so I make correction. And at break-even point, there was this sale 750, 450 as a variable cost, contribution was 300, fixed cost was 300, and you see there is no profit. And you must see here the profit 100 on overall basis, and you can see that the profit is also 100 at margin of safety level, because at break-even point there is no profit. So whatever profit we are getting, this is only because of margin of safety, because we sell additional 250 rupees. That's why we are making 100 rupees as in a profit. So it is very important to note that the profit element only is the part of the margin of safety, because at break-even point level, up to break-even point level, we're not in the situation to get money as a profit. Okay, so and then what will be the formula of margin of safety? Here is the margin of safety is rupees 250. So we can say the sale minus break-even point sale is equals to margin of profit, margin of safety. Now we can also calculate margin of safety with the help of this statement, like we are getting 100 rupees as in a profit, and we know that the whole fixed cost is observed by the break-even point, at the level of break-even point. So there is no fixed cost above the break-even level. So here the profit is also equivalent to contribution, and we know that if the contribution equals to the profit, and contribution is equals to 40%, then the sale will be 250. I hope you understand this concept. I'll clear this slide. Wait for a second. Sorry for interruption. Clearing now. Clear all trends. Now it's okay. Move to next topic. Desire sales. Desire means what? Desire means something we need, something we are dreaming. So suppose our same the statement is as we CFP, and 100 unit is the result of 100 rupees as a profit. We are getting 100 rupees on 100 units. Now we decide. We just we decide to twice our profit. So we are getting 100 rupees. Now we decided our target profit is rupees 200. How much sales we need? I know you are thinking that it is as simple as because we are getting 100 rupees on 100 unit. So for earning of 200 rupees, we need to sell 200 rupees. Why you are asking this stupid question? No, this is not as simple as that, because you'll find something material here. And if the profit is 200, definitely our fixed cost, what will be the selling unit? So our fixed cost was 300. So to making 200 rupees as a profit, we need to 500 rupees as a contribution. Am I right or wrong? Yes. And 40% is the contribution. So if the 40% is contribution, then 100% is 1250. Let's see again. 200 rupees as a profit. We need 200 rupees as a profit. Our fixed cost is rupees 300. So we need 500 rupees as a contribution. And contribution was 40%. This is 40%. This is 40%. So if the 500 rupees equals to 40%, then 100% will be, 1250. So we can easily calculate variable cost. So it is a reverse kind of calculation. Or if we sell 102.50, then selling price is rupees 10 per unit. So we need to sell 125 unit to get 1250 as a sale amount. So the desired sales, the formula of desired sales will be the whole calculation we need to adjust in this formula. So we add profit on fixed cost. So we add profit on fixed cost plus desired profit. Here is the contribution 500, and we divided by PV ratio, that was 40%. So the formula is the same what we did with this statement. So it's a reverse calculation approach. If we have amount of profit, and we need to calculate the sale units, so we need to follow reverse approach. Suppose sorry for interruption. And next topic is desired profit. Suppose we are selling 125 unit. At previous level we are selling 100 unit. Now we decide to sell 125 unit. How much profit do we calculate? I know the profit is always there, is there, 200 rupees is there. But now the question is that don't see the desired sales equations, just focus on the questions that if we sell, what will, if we sell 125, what if when we sell 125 unit, what will be the amount of profit? We don't know. So let's see. The sales will be 1250, and we know that if the contribution is 40%, obviously the variable cost is 60%. So we can easily calculate 500 as a contribution, and we know that there is 300 rupees as a fixed cost. So in that situation, we can easily calculate 200 rupees as a profit. So whatever we did, make it into this formula: sales multiplied by profit volume ratio, that is equivalent to 500 rupees, that is contribution, minus fixed cost, that will be profit. Okay, I hope you enjoyed this video. Thanks for watching.